Good afternoon, everyone. My name is Keast. I'm Vice President of Innovation and Development with Dream. On behalf of NAIOP, Greater Toronto Chapter, I'd like to thank you for joining us today for the webinar, Infrastructure Investment and Real Estate Converge to Unlock Opportunity. The chapter is proud to continue to offer exceptional programming and benefits to its members. In addition to regular webinar programming, you're invited to register for the Development Challenge Virtual Awards Night on October 22nd. In that, you'll be able to watch 3 finalists present live to a judging panel as they compete to win the 2020 Development Challenge. To register, please go to the website www.torontonaiop.org. And of course, all of our programming would not be possible without the generous support of all of the corporate sponsors. So want to send out a special thank you to all of them for continuing to support throughout. I'd like to introduce our panel today. Very excited. I think we have an amazing lineup of speakers today. And we have a really great representation of both private and public sector, which is something that we don't see often on panels, and I think it's really good to bring those two together because both parts of the industry need to work together to achieve our goals. So first up, we have Meghan Wong. Meghan is Vice President of Development Heavy Rail with Metrolinx, focusing on new station development. We have Jensen Clarke. He's the Director of Asset Management for Fengate, so has really interesting experience on both infrastructure and real estate side across North America. John Filipetti, Vice President, Design and Innovation with Oxford. Extensive experience in his tenure at Oxford on major retail and mixed-use projects across Canada. And last but certainly not least, we have Divya Shah, who is Senior Director of Investments at the Canada Infrastructure Bank. And I'm sure we've all been following the headlines and are very keen to hear from Divya today. Before we dive in, I think just want to make sure that we are properly scoping what we'll talk about. Infrastructure, of course, can span a very wide stream. So for today, want to keep the discussion, just for brevity, focused primarily on transit. We may also speak about long-term care, potentially some supply chain, culture, digital infrastructure, and maybe R&D and innovation. And just to give you a little bit of background of how the panel came to be, Mike Campoletti and Keel O'Sullivan are co-chairs of a programming committee with NAIOP, and they recognized that there was a lot of conversations happening both in real estate circles as well as infrastructure circles, where there was some overlap, but they weren't necessarily always having both groups in the same room at the same time. So out of that and the idea to converge that, this is how we have this panel. So diving in, Jensen, start with you. Tell us why it is that we should be bringing these two types of development into the same conversation, and are there opportunities that are being missed if we're not doing that? Are there cost or revenue implications, or is there ways that we can mitigate risk?
Yeah, thank you, Brad, and hopefully everyone's staying safe out there during these interesting times. It's a good question, and it's something that I've been trying to encourage for years, to be honest. I think it's a great idea to bring value for both the public and private sector. From the public sector standpoint, there's a variety of advantages to doing this. I'm largely a P3 developer, so that's the lens that I look at this question in largely. And by introducing development, you're able to subsidize the taxpayer's obligation. So that's the obvious one. It allows you to shift development risk onto the private sector, which is good for both parties, in my opinion. It allows you to overbuild in some cases, by leasing out unused spaces that are not currently, but maybe in the future, maybe maintained or used by a public entity. allows you to monetize land and repurpose that money into something that has a more immediate need. And just frankly, it allows you to bring real estate innovation in and around your core infrastructure, as a complement to it. So I really think it benefits the client in a lot of ways. From the investor side, not to be too selfish, but we're in a space where, especially with COVID, infrastructure is very hot. Meaning I have a lot of competition, my returns get squeezed. And this kind of hybrid approach allows us, frankly, access to higher quality projects with maybe lower amounts of leverage, better returns potentially. It creates upside for us. Fengate has an internal real estate business that we are able to leverage in certain circumstances to unlock value in projects, and this also gives us a competitive advantage. So, in all, I think it's great for both sides of the table, and I think it's we can structure it properly so that both sides can create some sort of win-win for each other.
Okay, great. Thanks, Jensen. John, want to switch to you from more on the real estate focus. What are your thoughts, and why are we having a conversation like this now? Because surely developers have been working with infrastructure as long as developers have been around. So has something changed recently, and how does that feed into Jensen's comments?
Yeah, good question, Brad. Why are we talking about this now? I think it's because we're gradually going through a transition period where an existing development model is being replaced by a new paradigm. And this is especially relevant in lower density and suburban areas outside of existing city cores that were originally developed, largely around the car. So people, residents and workers, they're now looking for a more convenient walkable lifestyle that doesn't require long commutes by the car, or doesn't require use of the car to just go and have lunch outside your home, which hopefully we'll all be able to do someday again soon. And so that transition, it's leading to refocused development into areas that are well served by transit. If you have two cars, you'd like to need only one. And if you have only one, you'd like to leave it parked all week and just use it, maybe on the weekend. So, that leads to the great interest in transit-oriented development. And, has this happened before? Historically, yes. In a way, development has always gravitated towards being close to whatever the dominant form of transportation is in each era. So, for instance, if you dial back your time machine into the 60s and 70s, the car and the expressway were the dominant mode of transportation, and new development clustered around highway interchanges. So, locally in Toronto, the examples are, Square One, Sherway Gardens, Yorkdale, Fairview, Scarborough Town Centre. They're all located adjacent to major highway interchanges. And then if you want to go back for an even, farther into history for examples, you can go back to the early part of the 20th century, late 19th century, where rail was the dominant mode. And so, development clustered around central stations and the streetcar suburbs that, were all built pre-war in North America. And then if you really want to go back farther, you can, before rail, water was the predominant mode of transport. So, ports and rivers and canals were where development clustered. So, we real estate folks, we're kind of parasitic when it comes to transportation. We like to be close to it, and that principle is that over time, people place great value on having access to mobility, whatever form that might take. So, I think that's kind of that's the broad sweep of why we find ourselves talking about it today.
Great. So, given that tight link, Divya, what is the federal perspective now? So John outlined sort of how often the real estate side would follow a lot of this great infrastructure, be it water, rail, highway. Now it looks like we're going back to rail. So what's the federal perspective from that and your role?
No, thanks, and thanks for having me here today. What a great time to talk about this topic. I think for me, this is just the right place where, or the right piece where CIB fits in. It is the moment where it's our job to bridge gaps and bridge risks. So yes, whilst developers are taking interest and they want to build real estate, and we want integrated communities, and we want transit-oriented development, historically, at least for the last 10 years, infrastructure lenders like infrastructure, real estate lenders like real estate. And the two just do not meet, and they do not collide together. And the creation of CIB, I mean, this was one of the first things I looked at when I joined the CIB, which is we can come in and try and bridge that gap and help developers with the build out of stations, build communities and infrastructure that's integrated, that allow for a walkable life and allow for an enriched life from a work and living perspective, but reduce the cost of capital for the developers so that we can actually all make our money back through real estate investments over time, over 30 years. So I'm one of the few investors that would be looking at both sides of the equation, happy to take infrastructure risk, happy to take real estate risk and crossover between the two. So for us, that's a sweet spot to play in, and where we can make these deals happen, that's where we would look to Meghan and Jensen and John and yourselves to bring, you know, projects together, and we can help, you know, connect the dots for you. So that's, I think, that's our perspective. You know, we've announced a really big program over on October 1st, and the idea there is to find these projects, to move projects both from infrastructure, real estate, and make sure that we are looking at carbon neutral and goals of the government as well. So, you know, that's what I would say.
Great. So then, Meghan, from the provincial standpoint, help us build on this a little bit. So what does the province believe that the public sector's role is here? Is it to be at the front end of that and provide the infrastructure that will then spur more development, or is it more to wait for the development to occur and then that builds your business case to be able to put in the stations?
Thanks, Brad. It's a great question, and thank you so much for having me. I think our perspective is being flexible on the approach and who should lead infrastructure for the right project. So with the TOC Transit-Oriented Community Program we have at Metrolinx, we are looking to third parties, developers and landowners to lead portions of the transit infrastructure so that they can manage the interface, the integration, and the ultimate built form for a truly complete community. But there is still a role for the province and for Metrolinx in transit delivery, operating the rail, of course, maintaining it, and serving the public in terms of providing public transportation. So I think we're in a really interesting space where flexibility is paramount, looking at each site-by-site case with the partner that we have, the capability. I think that plays into all sorts of pieces related to value, risk transfer, and how really the final deal and the product shape together. I think there are benefits to the province leading certain components, and some of those are our capabilities and our network-wide and provincial-wide perspective. But there are substantial benefits in letting the private sector lead pieces of infrastructure. There are efficiencies. You know, the one port concept, I think, is very much alive. If you can do something at one time versus in a piecemeal approach, we think there's a lot of efficiency to gain, and there's a lot of complexity in that, absolutely. But we think the value is there, and it would be worth it in the end.
Great. So Jensen, building on what Meghan just said and what Divya was saying in terms of just the bridge, and we've talked a lot about transfer of risk. So let's dive a bit deeper and just explain to us sort of what the key differences are and why you're so active on this, and where you see some of those opportunities starting to flesh out.
Yeah, absolutely. I mean, we've got the same investors in our infrastructure funds and our real estate funds. You know, so that kind of tells you that, look, these are at the end of the day, they're real assets, and really it's the contractual model that sets it apart. Is it infra? Is it real estate? I mean, you can take an asset like student housing, for instance, and on a continuum, you know, if one side's real estate, the other side's infra. If you've got off-campus development, you know, geared for students, where you own the land, well, that's a real estate deal. But if you're on campus and you've got some sort of guarantee, you know, from the university, that is an infrastructure deal. And in our opinion, in our lens, you know, so you've got all these projects that kind of straddle. I mean, at the end of the day, I think a real estate deal is look, you've got leasable space, and you have land ownership. So if this doesn't work out, hey, I can sell it and do something else with it. But on the infrastructure space, you know, I'm typically you know, being engaged to provide something very specific. And if it doesn't work out, I'm typically kicked off the project, and the government takes it over, and someone else will come in. You know, there's not the creativity to do something different with it. And I think really, you know, the element of having a terminal value is something that differentiates real estate and infrastructure. Because in infrastructure, all you've got really is the rights to a contract. You don't own anything physical.
So when you were saying if something doesn't work out, you get kicked off, can you explain that a little more? Yeah,
sure. And, you know, for full discretion, you know, we've never been kicked off of anything. You know, but look, a lot of the infrastructure assets are performance based. I mean, whatever it is, if it's a building, it has to be available. If it's a power plant, it has to generate power. You know, you have to perform. And typically, if you don't perform, there are mechanisms within these long-term arrangements that, you know, basically provide you warning at first, and then some more warning. But there is, you know, an Armageddon case that, you know, you are asked to be removed, and a new suitor will come along. I mean, we're seeing this. We don't see this very often, you know, right now. You know, there's a very unfortunate circumstance in Maryland with a very large LRT, Meghan, that would make you cringe, that basically has been, you know, the roads have been ripped up, you know, and it's half finished, and the project is in default. And, you know, and the developer really, they can't do anything else with the land. I mean, it's just there. So that's kind of what I was inferring by, you know, having performance metrics in the contract.
Okay. Well, yeah, let's hope for everyone on this panel and listening in that none of us get to that situation.
Never. It's very rare,
yeah.
You know.
So, John, let's talk about sort of that the idea of being able to come together. So where are we talking more about some of these opportunities that are starting to emerge? Is it and how do we work closer together? Are we talking about relationships? Is it more integration with technical design details? Is there policy development that we need to work on together that leads all of this? Is there savings on schedule implications? Just help us, like, really, we're talking a lot of sort of high level, which is great and sets the context. So, but help us dig in a little bit and where you see that things can come together a little better.
Yeah, those are all great points that you've mentioned, Brad. And I think, you know, to the point that Jensen made earlier, you know, no one wants to find themselves or their organization in that situation that he just described of, you know, where something can't be completed or performed. So that's a real challenge that I think, you know, a lot of the mitigation of that happens, you know, years and years before you're in that performance stage where you're building relationships with the various partners and you're planning through the different parts of the project and the different scenarios, because, you know, in both real estate and infrastructure projects, there's always unknowns that you only discover or are able to bring into focus as things progress. So I think that the early involvement of the partners is really critical on a couple different levels. One is on the level of developing an understanding of each other's operations and how they approach and I'll just call it a business, even though, the infrastructure folks may not think of it purely as an economic business. But you're still delivering this. You have a system that delivers a certain product and service. So, and the two parties are a little bit on different planets because often the real estate people don't have experience with, to use the example of transit, they don't have experience in that. And until recently, with people like Meghan and Divya, there hasn't been the thinking or expertise inside the transit agencies to start to understand what the real estate developer is dealing with. So building those bridges is really important on a sort of business level, but also on a just a personal level and an organizational trust level, where you start to understand and you have an understanding of each other's way of doing business and way of proceeding with your projects, and that can really help you get through the more difficult parts, which often will arise. It's never a straight line process, so that productive relationship is important. In terms of some of the other things you mentioned, Brad, those are all critical things. The policy, to start at the front end, policy is really critical because, and one of the things we still struggle with, I think, in Ontario and the GTA is there's still not a complete alignment between transit policy and planning policy at a regional level. So I think there's more work to do there, and I think it's getting much better than it has been in the past, but it's still not perfectly aligned, because when you have that alignment, everything works better and development just naturally gravitates towards the transit, and it's not distorted by, say, different tax policies in an adjoining municipality that starts to draw away certain uses because of a tax regime that's more attractive to the user, or perhaps the construction of competing infrastructure like highways. Is the highway construction and the construction of transit, is that fully coordinated in terms of how it's delivering mobility and how it is going to stimulate the kind of development that we all want to happen, in terms of being pedestrian oriented and not sort of car focused. And then there's a number of other technical points that you alluded to, Brad, that are critical too as you dig into it, and they can have serious implications on how tightly the two uses are integrated. So for instance, the structural requirements of trying to overbuild above transit can be very challenging, but the outcome can be incredibly attractive to users as well, to have that close integration. And the all the technical requirements of vent shafts and transformer vaults and service access, all those things need to be talked about, very as early as possible and as extensively as possible, so that the design teams have time to try to mitigate their impacts on both of those two complex constructions, being the real estate piece and the infrastructure piece. And I guess the last thing I wanted to mention was just the schedule uncertainty that often comes with a large, complicated project can be challenging on the real estate side, because we're through our leases, we're making commitments to deliver space to tenants at a certain time, and yet that's often reliant on the transit being completed or certain parts of the transit being constructed on a certain timeline. And if that gets disrupted, it has a ripple effect into the economics of the real estate. So that can be very challenging. But I think it goes back to what Brad was mentioning, or to what Jensen was mentioning earlier about the how a well-structured deal can allocate risk appropriately between and share it, in fact, between the the real estate side and the transportation side, and maybe that's where the infrastructure bank can help as well, because Divya says she can be comfortable bridging that divide as well, which is often the critical thing to bring the deals to fruition.
So building on that, and this is potentially a question either for Jensen or Divya, as someone with a perspective on both sides, how do you, as you're getting deeper into the project, and this happens all the time, where a design change necessitated by, be it policy or a site condition that happens on the infrastructure side, that ripples through to the real estate, and now new costs are being incurred by everyone, schedules being delayed. Is there opportunity, do you think, to work better to help mitigate that, or is that always going to be sort of on the private sector to bear that risk?
Divya knows the answer better than I do to this one, but I can jump in later.
I love you put it on me. What I'll say is, I think infrastructure projects, by its very nature, including real estate projects, are complex, right? So they will have delays. They will have problems that come up, and there are means and methods to manage these. And I think this is where I love when Jensen brought up the PPP performance risk transfer approach. I think there are lessons that to be learned in the way PPPs are managed, and the incentives and the risk transfer approach that a PPP takes. It's all about finding the party best able to take the risk, should be bearing that risk or managing that risk. And this is not about risk dumping on the private sector. It's understanding the risk and understanding how to manage it, and working with the private sector to there's no point in me putting on the risk which is so high of a delay or a burden that causes them for bankruptcy or causes them to walk away, because at that point we both have lost. So I think it's finding the balance, and it's working collaboratively together, and learning lessons not from just traditional approaches of infrastructure, but new contract management approaches as well.
Yeah, yes, absolutely. And I asked Divya to answer first because she wrote a lot of the contracts that I bid on. But like one of the clauses, right, in infrastructure is one of the key differences. Look, we bid like a fixed price, and there's like a 30-year concession period, right? And so things are supposed to be buttoned up at the beginning, and they're supposed to just work seamlessly throughout the project, and that's not the case. Design standards change, laws and regulations change, and they're just that's why there has to be mechanisms like variations and change order provisions to allow us to alter the project and to be fairly compensated to do that. And I think one of one of the things that we've found very helpful in our business is having a very robust asset management team behind the bid. So when things like this happen, you have a single point of contact to work with the client to manage the contract. If there's a dispute, which there will be, to professionally and manage that, and to ensure that the asset is performing the way the client wants it. So it's that kind of partnership mentality that we, infrastructure, I think we do quite well. And that's something that, maybe, could be brought into these hybrid projects as well.
Okay. Great. Thank you. That's good perspective. So jumping a little bit, moving to a sort of a different focus in terms of, want to talk to Divya. I want to ask you about sort of your team and how you are approaching investment opportunities, and how you and your team are making decisions. And let's pick a couple topics within that. So public transit and broadband. So how are you looking at this across Canada from both in terms of geography, Market availability. So for instance, are you going where there is a market, or are you going in because it's something that we should provide to people of the country, but there's not necessarily a sector that will spend that money because the return is too long? How do you look at national versus local parties? Those can often be very different.
All great questions, Brad. Thanks. I think I'll start off by saying that the $10 million growth plan that was announced on October 1st, the focus of that is quick, fast investments in key sectors and key initiatives. And the idea is looking at recovery and long-term economic recovery of the country through these quick and fast investments. And if you look at some of the priority sectors that were set up, broadband is clearly one of them. And the idea here is it's not broadband for urban dense areas. It's actually getting broadband for all Canadians and high-speed internet for all Canadians. Going through COVID, we all know the importance of the internet and what's needed to actually make business and the economy grow. So making sure the rest of Canada has 50/10 and high-speed internet is a really critical objective of the government. As you are well aware, probably, it is these projects that have very high infrastructure capital costs upfront. And because as you go out from the urban areas and you go into slightly not rural, even the semi-urban, there's not enough density to actually have a payback or a repayment, or it's not economic for internet service providers to actually go on their own and invest in infrastructure for internet for these areas. So our goal is to work with both the provinces, the municipalities, as well as large and small IPS or internet service providers, and see how we can install various types of infrastructure, work with them to get these projects moving across the various areas, and then work with them creatively to see how we can get our money back through user fees or through creative ideas around that front. What I would say from an investment decision perspective, I think I would say right now our phones are flying off the hook just because of the announcements, and it's quite an exciting time for us. Right at the start, CIB did not have allocations from a geography perspective. The idea is all about a state of readiness of projects. So, the stimulus financing that we have right now is a 24 to 36 month period. So the idea is let's find projects that are shovel ready. Let's find projects that can move fast in a really quick state of readiness. But of course, we as lenders, unlike or similar to Jensen in one sense, we still have to do our due diligence. We have to work through the contracts. We have to work through payback periods and the economics of the contract. And because of the unique role that we play, all our projects are expected to be uneconomical as they come to us. It's our job to be creative from a flexibility perspective, from a terms and conditions perspective, or from a the rate being sub-commercial perspective to make these deals economical. So I think it's factoring the both two aspects, which is finding shovel ready and quick projects, and then matching that with a responsible time frame and a focused investment approach. I'll just add really quickly that the investment decisions within CIB are pretty independent. We do need to look at social objectives and public interest, as what we call them, public interest objectives of both national, provincial, and municipal objectives. We try to mirror these and try to align them as much as possible. In the work that we do, because we're using taxpayers' dollars, it is all about public interest. And so making sure it's both at the local and national level must be met is a very critical piece. However, when it comes to pure financial and commercial aspects, our board is completely independent and has the ability to go really fast on making decisions. And we're pretty flexible on our approach when it comes to either working with the provinces or the municipalities with projects and their initiatives, or working directly with the private sector through unsolicited bids or needs or ideas that they might have across the board. So hopefully that helps as an answer.
Yeah, I think that helps provide a lot more detail. One quick follow-up question. So when you are looking at these different opportunities, do you have any sort of hurdle rate that you generally would have to hit, or a certain amount of payback that you're looking at? And it may change project to project or type of project by type of project, but is there any sort of guidelines?
I love that question, and I love the answer to that question is we don't really have a hurdle rate. That's not the way the bank works. It's all about projects. It's all about getting projects done that are in the public interest. And when you put the lens of social objectives and public interest objectives, it's not about hurdle rates. It's actually about moving projects forward that will benefit the economy and benefit the recovery of the nation. So, it's counterintuitive. We would almost want to take more risk at lower rates to make a deal work, but that's the fun of due diligence, and that's the fun of contract management for us.
Sounds like a very interesting place to be, for sure. So, Meghan, want to sort of just thinking of timelines, and Jensen talked a lot about sort of like some of the mechanisms that are in there to protect the infrastructure investor. Can you talk about, so from a transit perspective, I know there's been other panels that talk about the potential impact of autonomous vehicles on transit. So as you're entering these contracts, how is the risk for those major societal shifts being written into them, and who bears the risk sort of short term, and who bears the risk ultimately long term?
Yeah, thanks, Brad. And building off of what we've already discussed, the risk of being repetitive, I think again it's very contextual, and I want to highlight that the P3 model has seen a lot of success in Ontario. I think it's still going to serve many infrastructure projects quite well. But some of the projects we're looking at look at a developer or third-party led model, which might not be a P3. That's part of the province being flexible in terms of transit-oriented development and incorporating transit with wider communities. So a project like the Woodbine GO Station, where we've recently entered into a partnership with a developer, will be delivery-led by the Woodbine developer. So we're not going to be prescribing, similar to P3, those same kinds of provisions. With that being said, Metrolinx and the province are, of course, going to retain the risk related to our operations. We own the network, we operate the network. That's something we plan to continue. So the risk of impacts to transit will be retained primarily with the province. We do look at autonomous vehicles and all of these new initiatives of ways of getting around and mobility management as a positive. First and last mile has always been a challenge. This is about a wider mobility network, not just a rail line or a bus line. So all of these pieces are really important in coming together to make sure the province can move more efficiently, more cost effectively, in a way that's better for the environment. So I think while there are, of course, risks, we view a lot of these as positives, and we take a long-term view. Our business cases today look at a 2041 planning approach. We're living a huge risk right now to the network in terms of the pandemic, but we believe transit is a fundamental need. People are still using transit, maybe in not the droves they were during our peak commuter hours 6 months ago, but we believe transit will come back. It will continue to be a really fundamental need, and there will always be a role for cities in our society. So I think that piece is always going to be really important. And I just want to make sure when we're talking about risk, we're also talking about opportunity and value creation, because we're not asking for anyone to take any risk that doesn't have a reciprocal reward. I think value and risk inherently have to go hand in hand. And so this is, to Divya's point earlier, this isn't about being unreasonable or trying to bring forward projects that aren't really viable or set up to fail. It's about win-wins and opportunities to create value for everyone. That's not always an equal share of risk and value, but that's the beauty of each project being unique and evaluating that case by case.
Great. Okay, that's helpful. Thank you. Jensen, so taking everything that we've talked about, and now if you look across the country, where do you, and assuming, and I'm 100% aligned with Meghan was saying, I'm a strong believer that cities will always be the core, and I think that's the vibrancy that comes with those will bounce back. So given new infrastructure opportunities and the idea of we'll come back to some sense of how we used to, how cities have traditionally been used. Look across the country, looking at GTA, Vancouver, Montreal, do you think that there's any areas that have been overlooked for an opportunity for more sophisticated integration of infrastructure and real estate?
Yeah, I liked what Meghan said about value creation. I think it's really important for the government entity to run the numbers before the project comes to market, to really know that there is value creation there. It's not always the case, and look, there's a lot of U.S. states that are guilty of that as well. But not naming names on the actual geography, but I think there's kind of two areas that I think have a lot of merit to them. And I say this because we've looked at a lot of hybrid opportunities in these sectors. And basically what we'll do is we'll run a downside case to see what happens to the return. And in a lot of cases, the downside case will involve COVID. What happens if, heaven forbid, COVID stays around for 20 years, right? And we've seen a lot of these projects to be quite resilient, and that's basically why we like them. Just kind of the first area is around civic buildings, like city halls and office space, basically for the government. And we like projects, like these because they're typically in a good part of town, desirable real estate. So we encourage folks to overbuild so that if there are, additional staffing happening in this building, there's an easy spot to move into. But it's typically easy to tenant these buildings because there's a lot of auxiliary services that cater to the government that will easily move in. It makes bidding on government work a lot easier if you're in the same building as a government. So these civic style buildings is kind of the first one we like. The second one, as we've talked a lot about, is transit. There's the obvious integration of the TOD and condos and retail and I've even heard advertising that could be beneficial. I mean, in the US, I've even heard of a casino being shoehorned into a transit deal, Meghan. So we like those types of projects as well. We like the types of projects where, from a transit perspective, you might have an entity that maybe have two problems and they want to solve it with one project. I'm in the middle of a procurement in San Francisco where the city, basically, they have air rights, they have a housing problem, and they have just bought a fleet of new electrified buses and they need a new storage and maintenance facility. So what do? Well, they procure a hybrid P3 project where, as Project Co, I am, about a good chunk, let's just say, as we're on the air here, a good chunk of my revenue will come from the housing, but I take risk on that. But also there's that availability-based payment that will provide protection. And so I win because I get a resilient asset, and the city wins because they're getting a partial solution to their housing and they're getting a solution to their transit infrastructure.
It's good. I like that. And I'm glad that you started off with something other than transit. because it's easy for us, I think, to always focus on that. So, John, is there any other types of infrastructure that we should be looping into this conversation that you're seeing? Because you've obviously having large retail assets that are evolving, and especially as populations coming around them, what other things are you looking to on the infrastructure side that needs to be in there to make it better? And then from that, how are you approaching it? I think you're muted, John.
Sorry. I'm sorry about that. Yeah, there's no doubt that no meeting's complete without someone on mute. There's no doubt transit is really the key in the future of many of these assets, but because mobility is so central, as we've all discussed. But if you look beyond that, and if you look at assets that perhaps don't have the opportunity to have the immediate transit connection, then how do you overcome that hurdle? Because it's significant. You're looking for a way to create an attractive, engaging place that people will want to come to, that will have the kind of economic resiliency and durability that that Jensen is looking for, and that we all would be looking for. And how do you do that without transit? And I think the way that you can do that is to start looking at the types of uses that are not easily replicated in the online world. So things such as cultural institutions, entertainment uses, and similar uses that have a sort of social component to them, that where people feel there's great value in gathering together rather than staying, being remote and dealing with it on a digital basis. Health and wellness facilities are another type of alternative use that can be, real driver of activity for a location. And I think, I think for developers, they really have to be guided by, they have to get to know their community that they're serving and where they're located, because they are the ones that are going to be the first patrons of whatever uses you put in. So you really have to look at how you're serving them and what needs you're fulfilling. And of course, in our current circumstance, with such such a long reach of the online delivery of virtually everything, any trip outside your home becomes discretionary. So the offering has to be that much more compelling from if it's a discretionary expenditure. And then on the work side, on the workplace, I guess, environment, again, office space is a question mark in the sense of what will the demand be in the future, and really other types of uses that are related to employment, such as research and development, education, as I mentioned, health and wellness. These are all that are often digital driven by the digital economy rather than sort of competing with the digital economy. Those are things I think that will help to create a place that has that resilience and is economically vibrant going into the future. So it's, but I think it's really hard to do that without a good, solid answer to the mobility question. And I think it looks increasingly like if you don't have some level of transit integration as part of your picture, you're going to have some significant hurdles if you're relying entirely on car-based transportation. So I think I guess in summary, you have to have all those pieces together to get a fully resilient and an attractive place. You can't just have one without the other.
So just want to follow up on one thing that you were saying there, just because I have a personal connection with a cultural institution, so I'm always keen to think about these things. So you mentioned culture. So as a developer and large landowner, if there's things that you're putting in that you again think will create a really great community, how are you underwriting it when knowing it's a type of infrastructure that goes in before everything else, but then it may not have a payback. There's not necessarily any user fees. There's a lot of things that they're services for the public. They don't really make money. So how would you underwrite that and approach it?
Yeah, great question. And I would say we don't have a full answer to that yet. We're still working. Everyone is still thinking through how that can integrate. But I think it has to do with, on the one level, looking for at least some level of expense neutrality, so that the organization has some way of covering their basic costs through government funding or other revenue streams that they might have, so that at least they are able to maintain their basic facility. But beyond that, to your point about how do you pro forma something like that doesn't have a conventional revenue stream? It's really about footsteps and how it works to bring people to your location. And so it's a bit of a model that's related. We've seen it in some of our retail uses where the actual retail location doesn't actually sell any product. It's more of a showroom. And so you have to come up with a business model and a revenue model that's related to online sales that are driven through that specific location and that specific geography. So it's it requires some fresh thinking by all parties to understand how can the bricks and mortar facility tie into the revenue stream that is related to the footsteps that it brings to a particular location. So there's no one size fits all answer here, but I think if you're thinking about successful placemaking and driving revenue to other uses that you might have in your community or in your development, be it residential or retail or other uses. So you're adding value in that sense. You have to think about to what extent is that cultural use bringing people and bringing a valuable demographic to my location, and then those folks will then patronize other businesses that you have. Food and beverage obviously is a huge one, as well as just making overall your residential offering more attractive because you have this particular cultural facility located nearby. So it's there's no single formula that makes it all work, but you do have to think well outside the box to figure out how you can make sense of it economically. And so it's still a work in progress, but it definitely is. There's a lot of runway there, and I think it's a strong future driver for all communities.
Great. Yeah, I think it's a theme that we're seeing throughout today is a lot of just different ideas and creativity. And Jensen was talking about a little bit in San Francisco. So yeah, I think that's something that we'll definitely see more of, which is great. And so building on that, I mean, Divya, if you want to help expand a bit, what types of new deal structures do you see emerging from here that we may not have covered? And I'm specifically also thinking there's a lot of different players out there and a lot of different programs, and how might the stacking of all these different opportunities play in to create those different deal structures?
And so I think that's a really good question following John's answer. I would say as much of rigor and discipline we put in on investments, we have a very big creative license on structuring at the CID, because we have the ability to look at our term is not a fixed term. The hurdle rate is not a fixed hurdle rate. I can play anywhere in the capital structure, be it equity, sub-debt, or debt. My terms and conditions on the risks that I take could be, a variety of different risks. And I think it's that creative license that we've been given that helps hybrids. And hybrids is, for me, has been the theme of the conversation almost here is, as you're bringing traditional infrastructure pieces together, you're creating hybrids that are almost enhanced or are refined compared to their previous, or it's an evolution in the way we're doing infrastructure, right? And I find that really interesting. But to make that happen, it's working with the market, it's working with our advisors. We have to be creative in contract management and understanding the risks. So due diligence becomes important for us. You asked about stacking, or you asked about how do the different programs work together. It's a really good question. I think there's a lot more all layers of government can do in coordinating with one another and the programs that we all have. I think there's many funds and programs across the board that need a whole bunch of checklists that come with it. And more often than not, if you don't meet one of them, you don't apply. And I think, again, kudos to whoever created CIB, of course the federal government did, but kudos to the people who came up with the framework, because they didn't give us that dogmatic approach. They allowed us to go and work with Meghan on transit-oriented development and take real estate risk on the other side. Work on energy efficient retrofits, for instance, is a really good example. The traditional way of doing that project is reliant on getting guarantees from the owner. And typically that just becomes a huge barrier for someone like the province or a municipality in actually upgrading their buildings if they have to provide those guarantees. And just that puts them off, and they don't actually go and implement any of those projects. So we're trying to come in and work with the private sector to think about, if we can, as CIB, come up with a creative approach on payback period or flexibility in taking some losses, is there an ability just to rely on energy savings and not go to the step further of guarantees or availability payments that typically, cause municipalities to stop even exploring the project? So I think that's our approach, where we look at the risks of the projects first and try to unpack them and see how best can we contract around them. What can CIB do to be creative in managing those risks, rather than look at the project and try to achieve a hurdle rate? So I think it's almost turning everything upside down for us, which again, so much fun.
Does sound like fun. Looking at the time, we have about 3 minutes left, and we've received a few audience questions, and there's one actually that I think feeds in very nicely to what Divya was just saying, and it's for you, Meghan. So question around how you as Metrolinx fund things in general. So for instance, how much is coming from the province, how much it may be coming from private sector, I think in certain state circumstances. How would you feed in from CIB, and is there a portion that you need to go to a Schedule A bank for?
Yeah, that's a really great question, and I think it really does come down to the type of project, the delivery model, and the partner that we have. In terms of unsolicited proposals or developer-driven models, a lot of opportunity and value and risk for the private sector to lead some of the financing components. But the province still has their own initiatives, new transit lines being announced, for example, and there is a cost associated with that. And we are looking at many solutions in terms of how to finance that. And I think Divya has highlighted really well that there is a helping hand with the CIB to help bridge that gap, and that's something we're really excited to explore. But financing these projects remains complex. Infrastructure can't always be borne by the private sector, depending on the magnitude of it. And so it does come down to that value exchange. We're also thinking about post-COVID recovery, how to stimulate the economy, how to help the GDP recover. And so we're really looking at our dollar investments as well in terms of long-term what are some of those returns? It might not be the immediate kind of cash flow that a developer would look at. And that's where we balance being a business with also serving a public need and representing sort of public transportation for the province. So it's a really interesting balance we're trying to maintain.
Okay, great, thank you. So I think we have about 60 seconds left. So we'll put this out. Just quickly, we can go through if there's anything that you think that we've missed in a very short sentence. Jensen, have we missed anything?
No, I don't know.
Great.
I don't think so. I think we did a great job.
Excellent. John, anything from you?
I think it's been very comprehensive. I don't think we missed anything, but just to reiterate, like from everything we've heard, it's, talk early and talk often with your partners and potential partners, because that'll help things go more smoothly. Right.
Great. Meghan?
Yeah, I think it was a great discussion, but I would just leave everyone with, we acknowledge the technical complexity of these transactions, but there's so much opportunity, and just thinking creatively is so important.
Great. And I think we may have lost Divya, because I don't see her anymore on here.
I mean, she agrees with us, Brad.
Perfect.
Okay. Check.
That brings us to 1 o'clock. So on behalf of NAIOP, would like to thank everyone for joining. Really huge thank you to our panelists. I think gave us all sorts of great perspective. I've learned a lot. I have pages and pages of notes, and look forward to following up with each of you. Oh, Divya is back. Thank you, and thanks for joining us, and have a great day.
Thank you, Brad.
Thank you.
Thanks, Brad.
Thank you.